Thanks everybody for joining us for the last webcast, or the first webcast rather, of 2026. We're broadcasting live from Los Angeles today. And the title of this webcast is Clue. And I used the image of the Clue board game, which I used to love playing when I was a kid. It's really a logic game, and so I was pretty good at it. It's just processes of elimination. But basically, the Clue game is, who did the murder, what room of the house was it in, and what was the weapon. And so I would say here, relative to our situation in the United States, who is the perpetrator? It's us ourselves for voting in this political system and these politicians that are running the economics of our country in a very bad direction. So where is this happening? It's in our own country's finances. And what's the weapon? Well, the weapon is the deficit-based economy, which is intertwined with what I'm going to describe. I've been talking about this internally at DoubleLine for well over 15 years. Basically, it's being perpetrated with a circular financial scheme that we'll get into. Also, I thought of this title Clue because we all got to get a clue about what's going on, and we've seen some transparency with the frauds in Minnesota, and California, of course, will be bigger because it's such a bigger state. And there's lots of clues that we're going to be looking at as to where we might be headed. On the screen right now, though, is the bloodless verdict of the market for 2025. And we see it was a pretty good year. The only things that were down were the dollar, which if you're a dollar-based investor, you could have, and I recommended very strongly 1 year ago that you should have used that in your favor by investing in non-dollar denominated stocks if you're a dollar-based investor. We can see that that certainly worked. It was clearly a good year for stocks. The S&P up almost 18%. The NASDAQ up a little over 21. But if you're a dollar-based investor, you did much better in two areas that I recommended 1 year ago for a dollar-based investor: owning Europe and the UK, which were up about 35%. If you are a dollar-based investor with that currency translation profit, and also emerging markets, which we became very positive on in the middle of last year, which were up 34%. We see bonds were pretty good. All the traditional bond categories were up last year. The winner was something that we recommended strongly, and that was emerging market sovereign bonds around the middle of the year, which really got into gear at that time and finished the year up 13%. We see high yield bonds did well, up the second most here, together with the mortgage-backed securities index. That's an interesting combination because the mortgage-backed securities index has no credit risk, and high yield bonds, of course, have some credit risk, yet their return for 2025 was the same. But we see that treasuries did well, 2-year treasury up 5%, and a lot of mid to high single-digit returns. And again, the winner being emerging market sovereign. Leverage loans were low return, not because they had real stress, but simply because they're floating rate. And floating rate assets started to fall out of investor favor when the Fed started aggressively cutting interest rates. Ultimately, between September of 2024 and year end of 2025, there were 175 basis points of Fed funds cuts. Then we go into currencies. Of course, the dollar was down, as I described. Euro strong, up 13%. And then we see Japan flat, and then emerging markets up 8.8% on the currency. And then we have the commodities, which were quite a diverse set of returns. Gold up 64%. Copper up 41%. So big gains in both copper and gold. We used to use the copper-gold ratio as a starting point for the 10-year Treasury yield, but that completely stopped working in 2020 when rates bottomed. It seems to be that the copper-gold ratio only works in a falling interest rate secular trend, which we are not in anymore, as I've been talking about for nearly 6 years now. So the Bloomberg Commodity Index is up 16%. What was really down was the energy complex, oil in particular, down 15% on WTI and 18.5% on Brent. So agriculture had a small loss, but broadly commodities did okay last year. Bloomberg Commodity Index almost matched the S&P 500. There's a valuation report. We started this a couple of years ago. I think it's pretty helpful. We're taking a look at all these indices down on the x-axis. And what we're looking at is their valuation since the index began. Where is the present valuation versus the range since the index began? So on the left, we see S&P median forward PE is up at about 95 percentile. And that's true of most metrics on here are above 80 percentile. What seems to be on the low end, it's sort of an eye test here, looks like small cap PE is not as egregious as these others. And then over, we see CMBS is looking to be cheap. We like CMBS. We've gotten more bullish on CMBS in the past few months. We think that that market could well be the top performer in fixed income for this year. And then we see that CLOs, AAA, they are a floating rate and they have a relatively low spread because they're high credit quality. So that's among the lowest returns on here. But that's simply because it's a short-term asset that floats, and that means that it doesn't have a duration benefit for falling interest rates for the front end of the curve last year, and the coupon's been resetting lower. So it's a pretty overvalued market. Where you see doesn't look quite so bad are some things in the middle on non-U.S. bonds, looking just kind of average valuations or slightly rich, as opposed to most of the risk asset classes sitting at very rich levels. Now, here are developed market short-term policy rates by central banks. And it's really interesting how synchronized they've become. If you look at the right-hand side from 2020 to the present moment, they're all pretty much in sync. The only one that isn't seems to be the BOJ, which was slow to raise interest rates and hasn't raised them nearly to the extent that other central banks have. But the rest look like they're all run by the same group. It looks like a very coordinated effort. This looks a lot more coordinated than we were, say, back prior to the global financial crisis. Here's a look at the U.S. debt markets, just breaking down the various components. You'll notice the yellow line is Treasury securities, and it's just gone straight, almost vertical, since 2009 in response to the global financial crisis. And we haven't really slowed down at all with the issuance of treasuries. In fact, it looks like it accelerated starting in 2020 and continues at that same pace. Corporate and foreign bonds are rising as well, not nearly as quickly as the treasuries. Agency securities are rising about the same pace as corporate and foreign bonds. Munis are very stable. I mean, there is really no growth in the muni market. And then we have what they call the open paper market, which is also stable. Interesting, as we've had this huge surge in treasuries, in spite of the Fed cutting interest rates 175 basis points, you haven't gotten any relief from the drawdown of 2020, 2021 and 2022. We basically have the current 30-year Treasury index, the B of A Treasury index at the top, and we see at the bottom the drawdown. So we take the very top price of that index, and you look at where we are now, you're still, after all this time now, 4 years almost, down still almost 50%, and you haven't had really any relief on the long bond. It's basically at the same level on this index as it was back in late 2022. So very little going on there with the drawdown not improving, I should say, on 30-year Treasury bond. I think this is going to be a very long drawdown period for the price of the 30-year Treasury. It doesn't pull to par very quickly because of its long duration maturity, and it seems to me that long-term interest rates are having a very hard time falling, thanks to the fact that we have this huge growth in debt, and people are worried about the value of the dollar and the value of what your maturity principal will buy 30 years forward. But this has been a long drawdown for the Bloomberg Ag broadly. We see that back in the 87 period into the 2018 period, the drawdowns didn't last very long. There were only about a year of drawdowns. It's interesting when you look at the number of months column that it just keeps increasing. The lowest number was back in the 70s and 80s of 9 months, and then it went to 10, then 12, 13, 16, and now 65. I mean, something obviously changed between the 80s through the year 2000 and subsequent to the year 2000 So the drawdown was 17.2% maximum on the ag, which is pretty incredible. It was one of the 2022 was the worst year in the history of statistics on the bond market. So we have a very long drawdown here, and this is just on the max drawdown. Right now, the drawdown from August 2020 is not very big because the coupon has been big enough so that we're earning it back. And last year, of course, the ag did pretty well. So it was actually the 13th best year in the 49 years of aggregate bond investment grade indices. So it's about the 26th percentile versus the 49-year history. Let's take a look at various parts of the yield curve. See in the upper left, we have the 2-year Treasury, and it seems to have stopped falling. We've kind of matched the level back in the middle of 2024, although we're a little bit lower than that. We haven't been able to break to lower yields on the 2-year Treasury. It's interesting that the 2-year Treasury yield is about the same as it was the day before the Fed embarked on their 175 basis points of rate cuts. That's pretty unusual that the 2-year Treasury completely anticipated those 175 basis points. As I've said repeatedly on CNBC, you can say what you want, but I can prove to you that the Fed follows the 2-year, and now they're actually quite in sync with the 2-year. The 2-year Treasury is around 3.5, a little bit, not much higher than that, and the middle of the Fed funds range is 3 5/8. So the Fed is now pretty much totally caught up with the 2-year. It just took them 15 months to get there. Upper right is the 5-year Treasury. Looks a lot like the 2-year Treasury, except it's not at a new low. It's actually higher now than it was prior to the Fed cutting interest rates. So even the 5-year Treasury yield has risen during this Fed cutting cycle. Then the lower left, that's the 10-year Treasury. It's kind of in the middle of its range, going back 3 or 4 years, and also is meaningfully higher than the middle of 2024. So again, going up with the Fed cutting. And the 30-year Treasury looks totally different than anything else. In fact, it's way above where it was in the middle of 2024. So big losses on 30-year Treasuries, even though the Fed has cut rates 175 basis points. This has been my thesis that I've been articulating now for about 6-7 years, that we would not see the typical response to Fed rate cuts because the market is worried about long-term inflationary policies thanks to the circular financing scheme and the budget deficit. So the 30-year Treasury yield is having a very hard time falling at all. Here are yields across fixed income sector, and the gold rhombus is year-end 2024, and the blue bars are the year-end 2025. So we see is that yields across the board fell, with the exception of CCC junk bonds, high-yield corporate bonds, and CCC leverage loans. So the yields did not drop on the CCC high-yield bonds or CCC bank loans. Everywhere else, it's a very small move down, but yields did come down in every other sector. I think the biggest drop was in triple B non-agency CMBS, which is something that we continue to be bullish on, and certainly we're bullish on entering 2025. Spreads across fixed income sectors. So the gold rhombus is the year-end 2024 spread to treasuries on every sector, and the year-end 2025 is the blue bars. And here we see very little movement. I mean, if you look at investment grade on the left-hand side, the spread stayed virtually unchanged right across every sector. Mortgage-backed securities, agency mortgages, they tightened in a little bit over the course of the year. High-yield corporate bonds as an index, they've tightened in a little bit, except CCC's blind out during 2025. We see CCC bank loans, same story as in the fixed-rate coupon public high-yield market. And then we see that CMBS spreads were unchanged for agency. CMBS was unchanged for the agency, and the non-agency came in a little bit, not much. But when you get to triple B, there you saw a rally in the spread of CMBS. And except for double B, double B fell as well. And then asset-backed securities spread basically unchanged. EM Global spread came in a little bit. That supported those high returns we saw for emerging markets. And then we see emerging market investment grade in a little bit and emerging market high yield in. So a pretty good year for bonds. It was a volatile late first quarter, early second quarter with the tariff tantrum, but that was short-lived. And you look at this, and it looks like a low volatility year, which I would say, other than that maybe 4-week period, it was. Let's take another look at the 30-year U.S. Treasury yield. We created these channels way back when. I mean, it had to be 20 years ago, at least, maybe 25 years ago. And these channels, one's just a central line, and then you have this kind of two parallel lines along that, and one's kind of a channel. And so we see that the period from 1990 until 2020 was always contained within this channel. And now we've broken out above that channel, which is very important. It means that we have an acknowledged trend change. And so long-term interest rates have been rising. Short-term interest rates have been maneuvered lower, although the actual Treasury market was way ahead of the Fed in focusing in on the level of about 3.5% to 3.75%, which is the range for Fed funds. So what happened last year in Treasuries is interesting. The worst performing sector of maturity of the Treasury market was 30-year Treasury bonds with a return of only 3.3%. That's actually less than cash. So you're better off than cash than the 30-year Treasuries, in spite of the fact that intermediate term bond returns were pretty good. So we have an interesting thing. The 20-year Treasury bond and the 2-year Treasury bond were virtually identical with around 4.9% return. Then we see the highest return was the 10-year Treasury, but not much higher than the 3-year Treasury or the 7-year Treasury. So one of the best strategies for 2025 was a steepener in the Treasury market, being more focused on 7-year and in Treasuries and getting, if you wanted a duration that was like the 30-year Treasury, you could have leveraged the 2-year Treasury many times, and you'd have had a vastly superior return than owning the 30-year Treasury. It's interesting. A lot of people were slow to come onto this, but I think now, as I read many white papers that have come out looking for ideas for and predictions for 2026, a lot of people are still on board with the steepener. I am as well, but nowhere near as enthusiastically as I was 2 years ago when we started talking this way. I think the 2s to 30s, which is hanging out now, it got to 140 basis points, higher yield on the 30-year than the 2-year. Now it's settled down. It's about 130. I'm going to reconsider steepener trades if the 2s 30s gets to my target, which is 150 basis points. We'll have to see what the environment looks like at that time. For now, I still think the 2-year Treasury will outperform, at least moderately, the 30-year Treasury on a duration-adjusted basis. Let's take a look at the federal deficit, which is part of the clues of what's going on with the fraud and the circular financing scheme. We see that 2021, 2022, 2023, 2024 are all in the books, and they all had about $2 trillion of deficit. Yeah, it was higher in 2023 by a whisker than 2024, but it's interesting that 2023 and 2024, which were not big stimulus check years, they are higher deficits than 2021 and 2022. So deficit continues to rise, and of course, we are starting to see that some of this deficit looks like it's going to nefarious purposes. Scott Bessent was in the news recently saying that maybe $600 billion of the government's budget, which is around $7 trillion, so maybe 10%-ish of the budget is going to waste, fraud, and abuse. I would bet very heavily that it's a higher percentage than that when we look at the $24 billion that disappeared from California for trying to fight homelessness. Homelessness has only gone up, so that money appears to have been completely wasted. And then we've got the high-speed rail project that's been going on for 17 years that was supposed to be, I don't remember, it was like $6 or $8 billion. They've already spent $30 billion, and not 1 inch of track has been laid. So $30 billion, something like 4 or 5 times the anticipated budget with zero results. And now the high greed fail, as I call it, as opposed to high-speed rail, is now projected to be, the target now is to do 1/4 the size of the project. So not San Francisco to Los Angeles, but I think it's Bakersfield to Merced, a stretch that almost nobody would use. And the budget now is supposed to be $128 billion or $120 billion. There's different estimates, but it's more than $100 billion over budget, with 1/4 of the project now being targeted. So we're talking about a monumental overrun on this project. And I think it's clear, since we have nothing to show for it, that $30 billion was wasted there. So there's a lot of problems here. Here's the U.S. debt to GDP ratio going back to 2020. And it may be a coincidence. It may be cause and effect. It's interesting that as the gross federal debt in percentage of GDP went down from 2021 into 2023, we see that U.S. debt to GDP went down and the 2s/30s flattened. And then starting in 2023, the U.S. debt to GDP started to go up again. And lo and behold, the 2s/30 spread steepened out. I think this is due to the fact that as debt to GDP rises, the confidence in the value of your maturity principal on 30-year Treasury bonds is definitely coming into question. And it's not just in the U.S. This is a global phenomenon where long-term interest rates have been going up. There's some clues about what's been going on even prior to the Minnesota shocking results of perhaps $9 billion being basically stolen. We see whistleblowers say LA's top homeless official hired unqualified friends, tried to destroy public records. Nigerian CEO pockets $7 million. House committee probes Minnesota fraud scheme tied to COVID lending. Also, many other Medicare, Medicaid type programs and do-good programs like Feeding Our Future. Now people are realizing that there's a lot of money being stolen from building windmills and electric cars and other green ideas, which are starting to recede from favor because there's so much electricity need for AI and data centers, and you cannot power these things with windmills and solar panels. The latest unemployment scandal, state-paid inmates, $1 billion in fraudulent claims. How can that possibly happen? You don't even know that the inmates are getting the money. Then there's more on the Green New Deal. There's the California high-speed rail that I mentioned earlier, the high greed fail. And we've got internal homeless corruption needs to be dismantled. That probably relates to California as well. And now the White House is canceling clean energy projects in blue states. So lots going on. Another clue, the PPP. Remember that back when COVID started? Well, there were 11.5 million loans that were given, and 92% of them were forgiven, which seems a little shady to me. And then we see the total loan amount was $796.8 billion, almost $1 trillion, 96% of which has been forgiven. I would suspect that a few $100 billion of that forgiveness is suspicious. And how does this circular financing scheme work? This is something I'm starting to watch news programs and hear people talking about what's going on with all of this fraud. And they're not really quite, they're getting close. They're getting close to what I think is at the center of it. But like in the Minnesota thing, they're talking about they didn't want to upset the Somali community because they needed their votes. I've got a feeling there's more to it than that. Taking a look at the top here, we have federal spending on many projects, homelessness, Inflation Reduction Act, COVID response, Green New Deal. So a lot of money gets allocated. That's the next step. Federal dollars get sent to the states. So it goes through Washington, D.C. The spending starts there and then it gets allocated to the states. The states then distribute the funds with little or in some cases no or even intentionally looking the other way and not doing any oversight. And then the fraudster groups receive the funds. The states don't properly audit or oversee these groups. Maybe it's because they want their votes. Maybe it's because they're even getting a piece of the pie. Who knows? A lot of politicians seem to get rich relative to their salaries as politicians. Groups give to political campaigns to ensure politicians don't question, to keep the scheme going. So politicians are getting donations from some of the fraudster groups. We know that that's actually happening. It's probably happening to a greater extent than's been reported or people want to accept or believe. And so the groups give political contributions, and that leads to ongoing federal spending on those exact same programs. So it's a circular financing scheme. This is a problem, and we've got to get a clue on how to eliminate this circular financial scheme. Meanwhile, gold is on a moonshot. We see that it consolidated for about 4 years, right around 1800 to 2000. And I was positive on gold until it got into about 1800 and turned neutral at around that level. And I was waiting to see when it would break out to the upside. And that happened in early 2024. And we've just been on a kind of a constant run since then. I remember I was asked early in 2025 when gold was at something like 2970, do I think it's going to 3,000? I was asked on TV. And I said, what kind of forecast is that? I mean, that's up 1%. Can it go up 1%? Of course it go up 1%. In fact, when it breaks above 2,000, the target instantly becomes over $4,000. And indeed, gold made it to almost 4,500. At the close of the year, it was 44.59, and now is at a new high today, up above 4,600. 4,600. I think that gold is obviously going up because as the great Jim Grant put it in a recent podcast, the price of gold is the reciprocal of investors' confidence in central bankers. And it's clear that people are losing confidence in central bankers given their deficit spending and so forth. And the value of the dollar is coming into question as it's been falling, as we saw in the first slide. I think it's pretty clear that gold is going higher. It's been on a huge tear. But it's going up for a reason. It's going up because there are inflationary policies. We're heading towards the fourth turning. And by the way, Neil Howe wrote the book, The Fourth Turning, predicting that we have a financial crisis based on demographics around 2006. How's that? He was on a podcast recently with Julia LaRoche. It's called the Julia LaRoche Show. She used to be on Yahoo Finance, and he did a podcast with her talking about where we are relative to the fourth turning. And the point he makes, it's worth listening to, is you don't know exactly how it's going to shake out with the structural change that happens in a fourth turner. But in every case, regardless of whether it's a foreign adversary or internal strife, there will be inflation, is Neil Howe's his way of looking at things. So I think that the long bond is sniffing out these policies, and the long bond yield going up and gold going up is not a coincidence. Here we have IMF World Reserve gold holdings, which is just fascinating. Look at where they were in 1980. Gold holdings in 1980 were the same as they are today. And we see the central bankers sold down their gold holdings pretty heavily from 1990 until 2010. Well, they were selling gold at probably less than 1/10 of what it's worth today. And here they are since 2010 buying it back. And you'll notice the pace has not slowed down. So as the price has been going up, they're still buying lots of gold, and I don't think that's going to stop. Gold holdings once upon a time were something like 70% of foreign reserve holdings. That got down to about 20% down there in 2010, and now it's rising, but it's nowhere near 70%. I don't think it's going to 70%, but I think it can go to 30% of their holdings, and I think it's now up at around 20% or so. The actual numbers are quoted in the Roundtable Prime that we recorded last week. That'll be up on DoubleLine.com. There were a lot of comments about the central bank holdings that I think are worth listening to. What didn't do well last year was Bitcoin. I didn't have it on the chart because it's not really an asset class. It's the same as the other ones that were on that extensive bar chart at the beginning of the presentation. But Bitcoin was down about 6% last year, in spite of the fact that gold was up 65% and silver up even more. Silver always captures the imagination of retail speculators after gold has gone up a lot, and there's no exception in 2025. Starting in the middle of the year, gold started going on a tear. Silver is always a very speculative thing. I'm not a big fan of silver. I know a lot of people are. I have nothing against silver, but I think gold is the real money. So this is interesting, though. If you go all the way back to January of 2021, it's apparent that gold has outperformed Bitcoin. So gold has outperformed Bitcoin for 4 years, not constantly, obviously, and some setbacks on a relative performance, but it's done better, certainly in the last 4 years. Also, gold has done better than the S&P 500 for the past 25 years, going back to 2000. Now, that's not really an arbitrary start date. It's really a very high point in the stock market. But it is interesting that gold has outperformed what's been a very good 25 years for stocks broadly. Bloomberg Commodity Index is doing pretty well. We're now positive on commodities. We see that the commodity market, like gold itself, which is one subset of the commodity index, went sideways for a while there, and then suddenly it hasn't had nearly the breakout of gold, but it is now above its 200-day moving average. It appears to be in a rising trend, the BCOM, and the 200-day moving average is also rising. I think that this has a lot to do with the weakness in the dollar, and I think the weakness in the dollar is going to continue. This is the inverse of the dollar. That's the blue line. So it's charted when the blue line is going down, it means the dollar is going up. And then we've got the tan line, which is the BCOM, Bloomberg Commodity Index, and they're pretty correlated, as you can see. Sometimes they're not coincident. You can see 2020, 2021. Of course, that was a very unusual period with the lockdowns and all the stimulus and all that. But broadly speaking, these are highly correlated. And so we see that during 2025, the dollar went down and commodities went up. Here's the long term on the US dollar index going back to 1975, and it appears to be in a downtrend going back to 1985 when we had the Plaza Accord and the dollar was deemed to be too strong and was intentionally weakened. And we've had a peak again in 2000, and then we had a peak about 2-3 years ago. The one thing that's holding up, if you want to be a dollar bull, you've got that trend line from 2010, the low in 2010, and then we've got that where it kisses that horizontal line in the most recent observation in 2021. If you draw a trend line between those two observations, it would connect right at where we are right now in the dollar. So we're on a support level for the dollar at about 99 on the dollar index, which is heavily euro comprised. But at least you have that one thing going for you, is that trend line has held for the past few months. If we break below that trend line, I think we'll go into an acceleration of dollar weakness. That might happen coincident with Fed chairperson picked by Donald Trump may cut interest rates somewhat dramatically at the behest of the president. We'll see what happens. That's coming up pretty soon. We'll get the announcement of who it is. I don't think it matters very much what the name of the person is. That's the Fed chair. I think it has to do with the fact that Trump will use the acid test of a dovish posture in choosing the person. So you're going to get a more inclination to cut interest rates than you would have had under Jay Powell, say, a year ago. Here's a look at emerging markets. I find this interesting. I wish this chart was supposed to go back to 2015. So I'll just give you a word picture here. It's the JP Morgan emerging market spread to treasuries, one with Venezuela, which was excluded. The blue line was the only one that existed because the index, the JP Morgan Emerging Market Index, excluded Venezuela until you can see May of 2024 or so. And so you see that the ex-Venezuela is a much lower yield than with Venezuela. So when Venezuela went in, that blue line went up. That's because Venezuela had a really high yield. And so by including it, it raised the yield of the emerging market index. But we see that the yield to worst on the emerging market index is about 252. Right now, it's 252. That is actually a new low on that index on the index including Venezuela. So the one that excludes Venezuela is a lower yield. It's now at 214. That is 5 basis points higher than the all-time low, which was hit in 2018. So emerging market spreads are very tight. That doesn't make me negative on emerging markets. I'm certainly not wildly bullish on emerging markets simply because the spread's tight, but I think the spread is tight because it goes hand in glove with, it gives a clue as to investors are leery of the Treasury financing and the way the debt is being handled and the amount of waste, fraud, and abuse. So spreads should be tighter than they were, say, I don't know, back in the 90s or the 00s, because we have greater concerns about some of the problems in developed countries and in the U.S. finances in general. Here's the S&P 500 with its moving averages, and it's above all its moving averages and pretty far above its 200-day moving average. That should be a cause for short-term concern because you're pretty extended versus those long-term moving averages. But clearly, other than that tariff tantrum, it's been a pretty steep rise in the S&P 500. It's obviously been driven by some AI and data center and other technology-related stocks. We see that the S&P cap-weighted index versus the equal-weighted index has been outperforming pretty much nonstop since 2023 early on. So coming on 3 years, there's been a few reversals of the trend where the equal-weighted outperforms the cap-weighted. One of those times has been just recently. We see a small reversal, so equal-weighted has moderately outperformed cap-weighted S&P. I wouldn't say that this is definitive of a turning point, that suddenly equal-weighted is assuredly going to go into a long-term outperformance trend. It's possible, but we've seen false starts like this before. But the extent to which this has gone on is pretty extreme, and it's probably coming near an end. But I think it's premature to make a judgment that now is the moment to make the flip. Here's a similar story, S&P 500 growth versus value and total return, same type of thing. It's been a strong outperformance. This goes all the way back to 2007 with a huge reversal during COVID. But if so many idiosyncrasies about that time period, but it's been a huge move from 0.5 to 1.1, so a doubling of outperformance. Again, there's a small reversal here. It's not terribly convincing. I'd want to see something a little bit more sustained and impulsive, but we'll be watching this because at some point in this year, there's probably an opportunity to do these rotations. Now, one that does seem convincing is equity prices U.S. versus the rest of the world. This is simply the outperformance of the MSCI USA index divided by the performance of the MSCI World Index, excluding the U.S. So it's the U.S. versus everything else other than the U.S. And we see a very strong performance trend from 2017, small interruption during that weird period of COVID and stimulus, but we drew a trend line through there and we peaked out back at year-end of 2024. And ever since then, world stocks have been outperforming the U.S. MSCI index. And I would say this one is convincing. We have a big impulsive move. We've had a correction back up and it appears to be rolling over. So the recommendations that I have are very similar to a year ago. I still like metals. I like commodities broadly now as well as the metals. I like non-U.S. stocks better than U.S. stocks. I think if you want to be an aggressive investor, I wouldn't own any U.S. stocks. I would own local currency emerging market bonds. I would own foreign stocks in their local currencies and benefit from that translation. I think you should have something in real assets. I like land and gold and high value stores of value. Some people, there are other choices of real assets, but I think you should have. I have a lot of money in real assets, but I don't have a typical portfolio kind of construct. So I have much more in real assets than I have in financial assets, frankly. But I think one should have at least 20% in real assets. I think 30% in stocks at these valuations. I would have them in foreign currency, non-U.S. stocks exclusively. And then I would have about 25-30% in bonds. That would be the same thing I've been talking about now for a year, which is relatively high quality, not all pristine quality, but I would be avoiding triple C's and other riskier types of debt, which I'll talk about at the end of the presentation. And I would have it 7 years and in still. So the same thing. And then I would have the remainder, which might be about 20% in cash, because you're going to get better opportunities in the quarters ahead for entry points in risky assets, I believe, than you have today. This is really remarkable in how extended U.S. stocks are. This goes back to 1970 versus the rest of the world, and we see that sometimes the rest of the world outperforms. In fact, from 1970 until 1990, you went from one standard deviation from the average prior to 2020 to one standard deviation of underperformance of U.S. stocks. Then you had one standard deviation of outperformance, and then it just kept going. And so what used to be a very high valuation versus non-U.S. stocks has just been blown out of the water versus what we saw from 1970 to 2015 or so. And another reason that I don't like U.S. stocks versus non-U.S. stocks is the price-to-book ratios and other valuation metrics. The MSCI USA index has a price-to-book ratio of 5.6. The MSCI excluding the United States is at 2.26. So you basically have less than half of the price-to-book ratio in the non-U.S. markets, which will benefit from the currency translation as well that you have as price-to-book ratio in the United States. This is the S&P 500 versus the MSCI EM normalized. And so down at the bottom and the black line, you see now it's been going on it's coming on 18 months or so. You have the black line going down. That means emerging market stocks are outperforming U.S. stocks on just an index basis. And when you put on top of that the currency translation for a dollar-based investor, you ended up with 35% from MSCI EM types of stocks. And you can see just how extended the S&P 500 is versus the MSCI. They were exactly the same from the performance from 2015 into basically 2018, and really basically the same until 2020, once we got the drawdowns from COVID, and it's been outrageous outperformance since then. I think it's time to call it a day on riding the S&P 500. I wouldn't have any of it in a portfolio. Here's the S&P 500 versus the MSCI, so that's from the previous slide, and now we're just overlaying it on the U.S. trade-weighted dollar. This is a little bit different from the Dixie. It's trade-weighted dollar. And we see that there's a very high correlation. So the S&P 500 outperforms when the U.S. dollar is trade-weighted is going up, and it underperforms when it's going down. We've already started to go down. I think that's going to continue. So we're early on in these trends. So now I'm going to talk about a market that you should avoid. Sometimes it's not what you recommend. It's what you recommend you don't do. And I recommend you not do private credit. Here we see the leveraged finance market. U.S. direct lending market accounts for 30% leveraged finance. We see the pie chart on the left. Leveraged loans, just think of it this way for simplicity's sake. The leveraged finance market is leveraged loans, bank loans are about a third, a little more. High yield fixed regular way is about a third, and private credit has grown to be almost a third. So private credit is now basically rivaling the size of the public high yield bond market. And then we see what makes up private credit, which is BDCs, direct lending funds, and so on. So this is the growth of the private credit market. So the private credit market was a spec back in 2010, and then it started to grow a lot, I'd say really starting about 10 years ago, and then accelerating dramatically starting in about 7 years ago. And here we have now the $2 trillion private credit AUM by type. So we've got these different types on there. This is a classic deterioration of opportunity, in my opinion. When you have a nascent market that has inefficiencies and perhaps cheaper pricing, and some pioneers go into it and start to attract capital, they can have very good returns, and those good returns will attract more capital, which appears to be the case here. And then it turns into the Wild West. You go from the good sheriff that was taking care of a small town that was orderly and had a very low crime, and then someone discovers gold nearby that small town in the old Wild West, and suddenly people are pouring in, all kinds of rapscallions and corner cutters, and they come in, and all of a sudden it's very disrupted, and it's not safe anymore. I think that that's what happens in these nascent pioneer markets. They show great opportunity when they're small. The early movers do well. That attracts people that just want to get rich quick as operators of various programs, and it becomes a caveat emptor situation. And so just as we have a clue on what's going on with the circular financing scheme, clues are starting to show up via headlines. This is just Bloomberg Top Go headlines, where you see private credit firms to swap debt for equity in stressed 4840. The risks lurking in Wall Street's insurance takeover. This is one of the ground zeros, perhaps, of the private credit problem. Is the insurance industry is owned by private equity, and they own insurance companies, and now they're buying private credit with their insurance company, asset portfolio to fund any claims going forward. This looks like a very incestuous situation. Blue Owl money machine sputters in face of private credit cracks. Just came out a few months ago. Private credit's rapid evolution is raising risks, Moody's warns. One thought leader slams garbage lending to private credit, touts 20% cash, which I think I just did again. BlackRock private credit CLO fails key tests. BlackRock's a pretty reputable sponsor. It's interesting if they're failing key tests. Watch for the toxic trifecta in private loan losses. Apollo CEO is unfazed by cockroaches. Worries in the credit market. I think Jamie Dimon brought that up a few months back. Jeffrey seeks power firm debt buyers to replace private credit. So it goes on. There'll be more of these. I think this is something that you should avoid. And with that, that's my final slide. And try to keep it concise and precise this time. So I hope we all can get a clue as to what the trend is on and how we can maybe start putting the brakes on the circular financing scheme. So I recommend that you watch that Neil Howe podcast with Julia LaRoche. I found it very helpful. And he's a very engaging and interesting person. I'll answer one question because I usually don't do questions in the Just Market webcast. But someone says, am I still recommending the asset allocation of 25, 25, 25, 25? That was a long time ago. I've changed that recommendation several times, although I do fall not that far away from it from my previous remarks. Maybe 20% real assets, 30% stocks, maybe 30% fixed income of the variety I've described, and then maybe 25% or 20% it would be in cash. With that, let's go Bills, and let's have a great 2026. I think that it's going to be very interesting, and it certainly will not be a replay of 2025, which was a remarkable year, particularly given how strong 2024 was, particularly for risk assets. So good luck in 2026. Thank you for your support of DoubleLine, and goodbye for now.